In January, gold hit an all-time high. Then, it crashed, down almost 25%. Wall Street moved on. Gold's run is over. But they missed the biggest shift in decades. Last year, quietly, central banks started holding more gold than US Treasuries. Gold dethroned the dollar. So while everyone calls the top, the smartest money on earth is buying the dip. The real question isn't whether gold is expensive, it's whether $4,000 is the floor. Today, we find out. Today, we're not analyzing a company, we're analyzing the asset that has been money for 5,000 years, gold. Let me tell you exactly what you're looking at right now. Gold is falling. Back in January, it hit an all-time high of $5,405 an ounce. Today, it's near $4,030, testing the $4,000 line. Real yields have jumped, the dollar is firm, and Wall Street's interest, in their own words, has gone from a flood to a trickle. So the market has one message right now. Gold has run its course. It's over. But these headlines missed one thing. Last year, for the first time ever, gold overtook US Treasuries as the world's #1 reserve asset. The world's central banks started holding more gold than dollar government debt. So the question I want to answer isn't, is gold expensive? The real question is this: where did the floor under gold move to? And is $4,030 that floor? Let's break the whole thing down. Before we dive in, let's get clear on what kind of asset gold actually is. You need this for the rest of the video. Gold has one defining feature. It pays you nothing. No interest, no dividend. A bond pays interest. A stock pays a dividend. Gold just sits in a vault. That's why the tools we use on companies, price to earnings, EBITDA, can't be forced onto gold. There are no earnings to begin with. So what sets the price of gold? The key word is opportunity cost. Here's what that means. If you hold gold instead of a safe asset that pays interest, say a US Treasury, you're giving up that interest. That foregone yield is the cost of holding gold. So here's the framing I'll come back to all video. The price of gold is really the question of whether there's a reason to hold it even after giving up that interest. Hold on to that lens. The rest of the story runs on it. Here's the one sentence to hold on to. What changed over the last few years isn't the price of gold. It's who is buying it. What did gold used to be? Basically, two things. Jewelry, a consumer good, rings and necklaces, and an inflation hedge, something you held when prices were rising. That has completely flipped. The numbers make it obvious. In the first quarter of this year, jewelry demand fell 23% from a year earlier. Gold got so expensive, people stopped buying rings. But over the same period, demand for investment bars and coins jumped 42%, and central banks bought 244 tons. Total demand value hit a record $193 billion. And here's the spot I care about. The person buying jewelry and a central bank are completely different kinds of buyer. Jewelry demand is price-sensitive. It gets expensive, they stop. A central bank does not care about price. It doesn't buy because gold is cheap, it buys for strategic reasons. That difference is the backbone of the entire video. Price-sensitive demand left, and price-insensitive demand took its place. When the type of buyer changes, the floor changes with it. Now, I just told you demand is solid, so why is gold falling? Let me be straight with you about this because it's the most important part of today's story. The force pressing gold down from above, I call it the ceiling, is genuinely strong right now. Three things. First, real yields. Remember, gold pays no interest. But the real yield on a safe treasury, the interest after stripping out inflation, has climbed to 2.31%. If a treasury pays you 2.3% in real terms and gold pays 0, the reason to hold gold gets that much weaker. Second, the dollar is firm, and a strong dollar presses on a gold price quoted in dollars. Third, strong U.S. economic data has cooled short-term investors' appetite. But here's something crucial. That 2.31% real yield is actually the danger zone for gold. I'll come back to it in the risk section, but let me flag it now. At a real yield like that, gold would normally be falling hard. So gold slipping here isn't strange. It's the ceiling getting pressed, exactly by the textbook. And here's the key. Everything happening right now is a story about the ceiling, not about the floor. Here's the twist. Everything unfavorable to gold is in place. Real yields in the danger zone, a firm dollar, short-term money leaving. In that setup, gold falling into the mid-3000s wouldn't be surprising, and yet gold did not break. It's holding at $4,030. Why? Because the force holding gold up from below, the floor, is far higher than it used to be. Let me show you 4 signals. First, central banks aren't done buying. 244 tons in the first quarter alone, and the World Gold Council projects 700 to 900 tons this year. Poland was the biggest buyer. Second, and this is today's headline. As of the end of last year, gold's share of the world's central bank reserves rose to 27%, overtaking U.S. Treasuries at 22%. The first time in history gold ranks number 1. That's a figure the European Central Bank published directly. What does it mean? This isn't a trading headline. It means the world's central banks are shifting their trust out of dollar assets and into gold. And because they're doing it out of trust, not price, it doesn't reverse easily. Third, money left Western gold ETFs, but Asian inflows offset that outflow. Gold is moving from hands that sell into hands that don't. Fourth, supply can't grow as fast as the price. Mine production is already at a record and still capped, and new mines take years thanks to permits and environmental rules. So put it together. The fact that gold holds at $4,030 under the worst possible conditions for gold, that holding, right there, is the clearest hard evidence the floor has moved up. Now let me properly unpack today's core idea. Get this, and you can carry it to other assets, not just gold. Here's how I frame it. The price of gold is a scale, with 2 kinds of demand pushing from above and below. The top, the ceiling, is pressed down by price-sensitive money. Speculative capital and short-term investors who do the opportunity cost math and walk when real yields rise. They sell the moment conditions turn. So the ceiling is set by real yields and the dollar. The bottom, the floor, is held up by money that doesn't care about price. Central banks buying to diversify reserves, people who've lost faith in paper money. Countries buying gold as insurance against geopolitical risk. What they share is this. They're not buying on a yield calculation, so when the price falls, they don't sell. They add. That money builds the floor. So the 2 questions to actually ask about gold are, 1, where is the real yield pressing the ceiling? And 2, where has the price-insensitive demand moved the floor? And right now we're in a rare moment. The ceiling pressure is near maximum, and the floor is winning anyway. Why did I spend so long on that scale? To see this moment clearly. For gold, the real yield is the strongest enemy there is. Gold is so tightly a mirror of the real yield that when the real yield rises, gold falls. Inflation, not real yields, that's the common mistake. Even if prices rise, if the real yield rises more, gold falls. And right now, that strongest enemy is near its maximum, at 2.31%. Normally, in these conditions, gold should be breaking down hard. Instead, it's sitting at $4,030, off its high but far from broken. And here's the spot I care about most. Taking the full force of the ceiling and still holding here means the force pushing up from below has gotten that much stronger. If the real yield comes down even a little from here, the pressure on the ceiling releases, and gold can open back up. Think of it as a spring, wound down as tight as it goes. Let me put this into numbers. Gold isn't a company, so we can't compute a target the way we do a stock. Instead, we assume a price per scenario. 3 of them. First, the bear case. If real yields push above 2.4%, the dollar strengthens further, and central bank buying slows. Gold sits around $3,980, about 1% below here. The base case. If real yields settle between 2 and 2.3% and ETF flows recover, the target is $5,150, about 28% above $4,030. The bull case. If real yields fall below 2% and geopolitical risk builds, $5,600, 39% up. 2 things to flag here. First, that base case 5,150 is not an aggressive number. This is an asset that already printed 5,405 back in January. We're not asking it to break a new high, just to get back to where it's already been. And JP Morgan is holding a year-end target of $6,000. My base case is actually more conservative than Wall Street. Second, let me be straight with you. The risk and the reward here are extremely asymmetric, about 28% up, while the invalidation line is right underneath us. Why? Because the price has already fallen to the level where it's testing the floor. Seen positively, that's the best entry there is if the floor is real. Seen coldly, it means the near-term risk of that floor breaking is just as close, which is why the next part matters. So this question, is the floor real? When does it get settled? The good news, it gets settled by data, not by vibes. I call these the scoreboards, and there are three. One, US real yields and the dollar. If the real yield falls below 2%, the ceiling releases and gold can retest $4,800 to $4,900. If instead it locks in above 2.4%, the floor comes under threat. 2. Gold ETF flows, specifically the east versus west direction. The key is whether Asian inflows keep offsetting Western outflows. 3. The second quarter gold demand data, out in late July and early August. Whether central banks keep buying, that's the most important one. So here's my read. The direction is bullish, but the discipline is to scale in, not buy all at once. The more the floor proves real in the data, the more you add. If the scoreboards break, you trim, and the invalidation line is clear. If gold settles below $3,950 on a weekly closing basis, that means the floor has moved down, and today's bullish thesis has to be scrapped. Being bullish doesn't mean only showing the good side. Let me be clear about the risks, and today's are a little unusual. The first and biggest risk is real yields, and this one isn't hypothetical, it's happening right now. As we saw, the real yield is already at 2.31%. If it climbs above 2.4 and locks in, and the dollar pushes past 103, the floor gets breached, and the base case has to come down below $4,600. Today's bullish thesis rests entirely on the floor holds under this pressure. Break that premise and you break the thesis. Second, the risk that central banks turn from buyers into sellers. Even this year, places like Turkey and Russia sold some. When a country is under pressure, gold is a handy emergency asset to cash in. If central bank net buying drops below 100 tons for 2 straight quarters, the very premise of the floor starts to shake. Third, high prices hurt demand and supply at the same time. Jewelry demand is already down 23%, and higher prices pull more recycled gold into supply. If that combination worsens, the target has to come down, which is exactly why the scaled entry and the invalidation line matter. Let me bring it together in one sentence. Gold's ceiling is clearly capped, but its floor is clearly higher than it used to be. The core, one more time. Gold pays no interest, so gold's enemy isn't inflation. It's the real yield. And right now, with that enemy at its strongest, at 2.31%, gold hasn't broken. It's holding at $4,030. Why? Because gold's friends are the buyers who don't care about price. Central banks, people who've lost faith in paper money, buyers of geopolitical insurance. And last year, for the first time ever, they held more gold than US Treasuries. So back to the question we opened with. What you should be asking isn't, is gold expensive? It's, is $4,030 the new floor, and will they buy again, right here? And the best part, that answer arrives not on a hunch, but in data, within weeks. Real yields, ETF flows, and the second quarter demand report. That's why I'm watching gold closely in this zone. And one last time, clearly, this is my analysis and my opinion. It is not financial advice. If real yields keep climbing or central banks turn sellers, gold can move hard, and the downside risk is real. The final decision and the risk management are always yours. If this was useful, a like and a subscribe genuinely help the channel. And I want to hear from you. Do you see gold at $4,030 as a rally that's ending, or as a floor that just moved higher? Tell me in the comments. I'll see you in the next one.